year-over-year change would be in the San Francisco Bay Area Case-Shiller, and it actually ticked up, an insignificant, went from like 6.5 to 6.7, so it kind of stopped at the 6.5%. And that's down from 12% a year ago. So that's kind of been a little bit of a, not that I want to talk. I mean, that's nothing to talk about. That's kind of boring, but that was just like the last thing I printed out on the way down here. So,
do we know of anybody who'll make a loan in Portland?
Yeah, residential mortgage. Or
No, commercial.
So anyway, I think I'll just talk about the stock market. It seems like that's kind of the 2-year dud market, and the next 10 years will be ugly for your 401k.
Yeah.
cool. Phone?
Shoot. David did something to me here now. Can't undo it. David, what'd you do to me? Well, actually.
So,
Right.
Robert, you got some?
Yeah, I
Got a
got
few
some.
things?
I got some general stuff.
Okay,
So
good. Well, we'll just talk in general.
I've got David's mortgage statement.
Well, in
and,
general.
California named Mortgage Trust Capital of 2016. No big surprise there. Wells Fargo could lose 30% of its customer base. I have an interesting take on that. Piggy, people in
Well,
California.
that's more exciting so far. Yeah, that's more exciting. This one's not that exciting.
Yeah, not that exciting.
This one's
People in
cool.
California are starting to use their homes as piggy banks.
Again?
Again, yeah.
There you go. Nearly 1 in 4 markets less affordable than historic norms.
Okay.
So we got some stuff.
Yeah, I like the Wells Fargo one, and I definitely want to talk a little bit about the next 10 years will be ugly for your 401k. This is Bloomberg. I'll pick it.
Write down the times for you. Okay. Actually, no, I can't list. Changed a little bit. All right, who wants to start?
Mark can roll with the stock
Yeah,
market
I'll
one. I
start
think
with
it's pretty cool.
the next 10
Yeah,
years.
that's actually probably pretty good. Okay, and away we go. Welcome, you're listening to The Best of Investing. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, one of California's fastest growing mortgage investment firms, and Rob Spinoza of RPM Mortgage. Our phone number is 888-912-1190.
Come on.
888-912-1190. Use that number to answer the trivia questions for 3 tanning certificates given away during this show. And those certificates are not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Mark, let's just get right into it. By the way, our trivia theme is numbers. Okay?
That'll
And
narrow
speaking
it
of
down.
numbers, yeah, the number 6.
Well, usually when we got have Rob Spinoza in with us, another real estate broker, and my company, Pacific Private Money, makes real estate loans. We typically have a real estate show, and I know we're going to talk about real estate a little bit later, but I got to talk about this article this week that I got forwarded to me actually from several sources, and usually people forward me articles, but not the same article. And this was one that made headlines this week, and it was from Bloomberg. So reputable, not one of those like Business Insider ones, which by the way, is Business Insider like the TMZ of financial reporting or something? I mean, those articles are so absurd sometimes, but I digress. This Bloomberg article headline says the next 10 years will be ugly for your 401k.
Oh boy.
And it starts by saying it doesn't seem like much to ask, a 5% return, but the odds of making even that on traditional investments in the next 10 years are slim, according to a new report from investment advisory firm Research Affiliates. Essentially, what they're saying is that a typical balanced fund with 60% stock and 40% bonds has a 0 chance of returning 5% or more over the next 10 years, and 5% seems to be like the minimum target that people use when they're predicting their yields. In fact, many people use 6 or even 7%.
But they're saying it's a 0% chance?
They believe it's a 0% chance.
That's really aggressive.
That's like, no.
I mean, usually they'd say, well, there's a 20% chance of this or 10% chance of that, but a 0% chance? Okay.
Well, I have an interesting spin on this, and I wonder how you guys would interpret this. One of the things we've seen a lot of in the Bay Area housing market, where you have you have a good rate of employment, you have a lot of people that are in good jobs that are saving for their 401k and also looking to become homeowners. We've seen a lot of those individuals use a portion of their 401k to buy real estate. So I'm wondering how this advisory firm might view something like that. So in other words, if you took out, and everybody does that with great trepidation, right? So if you're going to raid your 401k to buy a home, most investment advisors are going to say, oh, don't do that. You know, your Susie Orman's, oh, no way, don't do that at all. But then here you have this company saying there's a 0% chance that you're going to return 5% over the next 10 years, right? And if you had that in your house, how does that change the equation?
Yeah, that'd be interesting because it does go on to say in the article that a lot of retirement calculators, predict that we'll make 6 or 7%, and so people save based on that.
Right.
But if they're only making 3%, they're going to have a massive shortfall. They'll have to work longer or retire with a substantially different standard of living than they thought they would have. Moral of that story: since most people's risk tolerance isn't likely to change dramatically, the amount you save may have to. Well, that's their moral. My moral of the story is, if you're going to rely on stocks and bonds and a balanced portfolio of stocks and bonds to pay for your retirement lifestyles, be prepared for a pretty lean times. But if you've been listening to our show, The Best of Investing, which has now been on for over 6 years, we've been talking about mortgage investing and other alternative investments as a very effective and impactful way to boost the yield you earn on your savings. And even though we've seen some yield compression in our fund, we were consistently over 8 for several years, and now we've ticked a little bit below 8. 7.8%, not a bad yield. That's our year-over-year returns right now.
So he doesn't have the same 0% chance of reducing over 5%.
And just one more article about the stock market while we're talking about it. This was this week in USA Today, titled "The Dow's 2-Year Trip to Nowhere." And it basically says that 2 years ago, we celebrated a major landmark in the Dow when it passed 18,000 in December of 2014. Where is it today? 18,200.
There we go.
So, and it's gone up and it's gone down and it's gone up and it's gone down. And so if you're a market timer, you've probably done a lot better than zero over the last 2 years in the stock market. But if you're not, if you're simply an index investor, are you better off today than you were 2 years ago? To paraphrase Reagan from how long ago?
That's right.
So I want to also comment on the start of 2016. If you guys can recall that far back, my memory's a little shot, but yeah. This year started off on a very weak note, right? And I think a lot of people were looking at where this year would have to end in order for us to be up at all, given the start to the year.
Yeah.
I think when you look at your retirement investments, you also have to keep that in mind too. So depending on your age, this 10-year thing could scare the bejesus out of you, or it might be, okay, well, I'm in this thing for another 20, 30 years before I retire, so I'm just going to, set it and forget it and let this thing ride out. But
Can't do that.
I don't think you can do that anymore. And I think most investment advisors that I talk to are also getting wise to the idea that, you can't set and forget. Even if you leave it, stocks and bonds, in your 401k, are you managing the expenses? Are you aware of what you're paying within that? I'm seeing more and more of that, and I think the moral of the story here, because I wanted to touch on something a little later, that we'll cover with the Wells Fargo thing, even though I'm not allowed to talk about it, is you've got to be smart about your money. It's not up to the government. It's not somebody else's responsibility. It's yours.
That's true. Okay, guys, we're going to cut to our first commercial break. Before we do, I want to make a quick mention here for the new Cityscape Viewing Lounge at the Hilton San Francisco Union Square. They have 360-degree views that are out of this world. On one side, you can see AT&T Park. We'll run over to the other side. You can see the Golden Gate Bridge. It is awesome. Totally glass floor to ceiling. All right, here is our first trivia question about numbers. According to the nursery rhyme, how many blackbirds were baked in a pie? The first caller with the correct answer wins that free tanning certificate. Call 888-912-1190 to answer that question. And don't touch that dial. The Best of Investing will be right back. Okay.
This time I'll turn the the clock on.
Oh,
it was 6:15. Okay, I thought for some reason it was like 5 or 4 minutes or something that we were going to
No.
way over. So
My tools. My highlighter. Where's my highlighter?
I want to go back just to recap a little bit on that story. A couple of things that
By the way, questions? Yours about the cosign.
Yep.
Okay, Mark. With interest rates still hovering at record lows, will you continue to be paying around 8% in your fund?
Thank you. That's perfect for dovetailing into this. So let's come back. Let me
Yeah,
come
finish
back and just do an intro on this, and
Yeah, no problem.
And then you
I
were-
can dovetail. It's cool.
Yeah.
we're good.
Okay, ready?
Yep.
Okay, you gonna do this way?
oh yeah, and this is 910.
Yes. Yes. Okay, here we go. Well, welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. First trivia question, talking numbers here. According to the nursery rhyme, how many blackbirds were baked in a pie?
4 and 20 or
That's-
24?
Or 424, yeah, exactly, or 24.
I was gonna
That's
say
right.
4.
4 and 20.
Four
Yeah,
and
I don't know
20.
why it was like that, but I guess they baked 4 and then they added
Because it's a
24.
poem.
Oh, there you go. All right, Mark, continue on, please.
So we were talking last segment about two articles, one in Bloomberg and one in USA Today. The Bloomberg article was entitled "The Next 10 Years Will Be Ugly for Your 401k," and the USA Today article was titled "The Dow's 2-Year Trip to Nowhere." And the point being that stock portfolios and of course bond portfolios are underperforming, and the key to these articles is that there isn't a big expectation that that's going to change in the coming years. And I've shared on this show several times that as far as a year ago, last summer, not just the summer of 2015, that I read a major article in, I believe it was also in Bloomberg, that predicted that stocks would underperform over the next 10 years. So there's been a theme in these articles that have been coming out, and deeper into the article, it talks about how if you are accustomed to a traditional portfolio of a certain percentage of stocks and bonds based on your age, and the suggestions on how that portfolio should change and be weighted over the years, it predicts that to get higher returns, you'd have to take on what a lot of firms call maverick risk. And that means holding a portfolio that could look very different than what you're accustomed to. Well, I'm going to first of all, I say the term using the term maverick risk, that's BS. I mean, what you really need to do is
That's
take
deviating
charge.
from, yeah, exactly.
You got to take charge of your portfolio,
Right.
and while you should always have a diversified portfolio, which contains a lot of traditional investments like stocks, like bonds, like other things, you should also carve out a percentage for alternative investments, including real estate, as you alluded to last segment, Rob, and things like mortgage investing, like maybe you invest in individual notes or mortgage pool funds like we offer at Pacific Private Money, and like many very good and excellent companies do throughout the state of California and other states as well. There are a lot of alternative investment options out there that have safety and security features if you know how to study them.
Well, I was going to ask you about that, Mark. So what I was alluding to before was when somebody goes to buy a home and they look for their down payment funds, we've seen more and more individuals look to a 401k loan to either augment or be a large part of their down payment. But what you're talking about specifically is private note investing and things like that that can be put into a self-directed IRA, correct?
I am. And so if you have a self-directed IRA, and I'm not talking about an IRA with one of the big brokerage firms that might even use the term self-directed, but really all they mean is you get to pick from their menu of stocks and bonds and other types of things. You have to have a true self-directed IRA with a company like IRA Services here in the Bay Area, where Edward and I both have our true self-directed IRAs. And when you have your IRA monies in one of those accounts, you can actually buy real estate in your account. You can invest in a mortgage-backed note. You can invest in mortgage pool funds. You can buy gold and jewelry through there. You don't have to do it through, limit yourself to just over-the-table liquid stocks and bonds.
So they basically administer those types of assets within the retirement account.
Yes, they do,
I got it.
absolutely.
Okay.
Yeah, they do. And so you made a little mention earlier about Wells Fargo. You've got an interesting article there. Someone's predicting that maybe this issue with those bogus accounts is going to have more of an impact on Wells than they are leading on.
Well, specifically the article says that they could lose up to 30% of their customer base. And where I want to go with this may not be where you would expect I would go with this. So Wells Fargo is a competitor of ours. I'm with RPM Mortgage, and we operate in the same environment where we're competing for residential mortgage loans, and Wells does a great job of that where they do it. We also have Wells as a correspondent, which means that they're one of the investors that we can select when we go to
They're
find.
friendly, in other words.
Yeah, they're so I'm the last guy that's going to go after Wells and say, yeah, they did something wrong and therefore, they should be burned at the stake. Wells has this customer base, prediction. I feel is not accurate because even in the last week, despite all of the bad press, we've competed against Wells on a number of deals, and the customers that have been, pitting them against us have had no issue with this. So I think it comes down to dollars and cents, and I also think in the case of banking, Wells comes down to convenience. I mean, you can't throw a stone here in the BayArea and not hit a Wells ATM, right? I mean,
Right.
They're everywhere.
And their technology is fabulous.
Yeah,
They got the best ATMs around, and I bank with Wells Fargo.
So-
and I have a Wells Fargo home mortgage, and I love the online banking. I can do wires, I can transfer money around like crazy. I can do just about
Right.
anything I want to do on their website.
So where I'm
And
going,
my mobile app.
there you go. I know a lot of people in mobile banking, right? So
Yeah.
where I'm going with this whole thing is that when you're watching Wells, take the beating it's been taking, realize that without Wells in the picture, you as a consumer, your choices are going to be limited because
Right,
what
you actually
happens?
lose out.
You're going to lose out
Yeah.
because what happens to Wells is also going to happen to Chase. It's also going to happen to B of A and Citi. And even if it doesn't happen to them, don't think for a minute they're not going to be on red alert for the same thing to happen to them.
Well, or the antitrust, they'll say less competition, we're going to swoop in.
Right.
And you're making a good point, though. What I think is going to happen is I think heads are going to roll.
Of course.
I think more people are going to get fired
Right.
at Wells than we were led to believe when Mr. Stumpf kind of waited a little bit before
Right.
he finally saw the writing on the wall
Right.
and retired, quote unquote. But for the consumer, I got to think that this is actually potentially going to be a good thing because they're
Possibly.
going to bend over backwards to
To meet
try
the
to do the
yeah,
right
yep.
thing to salvage and save the reputation and to provide the best services and to go out of their way not to be confused or ever accused again of doing this kind of activity.
I agree with you on that, and I would say this, and just last week, as a matter of fact, I was looking at an applicant's bank statements, and he banked with Wells, and lo and behold, I see the 6 or 7 accounts, and there's very little money in any of them, and I'm almost certain that
They didn't open all of those.
They didn't open all of those
I
because
don't need 14 accounts with $5 in them.
So, but at the end of the day, I feel, and this is me talking. This is not RPM talking. This is Rob Spinoza talking. But I feel that if you have accounts on your statement and you don't know what they are, you make the phone call to Wells and you say, "Hey, why is this there? Have I been charged any money on it?" And you get out of that predicament. They were not. They were clearly wrong to set them up under whatever incentive plan they had. I'm not giving them a pass here. But I think that, again, to touch on our earlier theme, whether it's your 401k, whether it's your regular checking and savings, whether it's your mortgage, it's your money, it's your responsibility. And if you're listening to the show, that's the whole concept here, best of investing, but it's also the best of everything you do every day with your money. And you got to be careful about that because it's a complex environment, and you're looking out for your own store. At the end of the day, it really comes down to you. It doesn't come down to Elizabeth Warren and Richard Cordray and all the other people. It's up to you.
It's an opportunity to force them to stand up,
Yeah.
be counted,
Earn your business.
right? Earn our business, take responsibility for what they did, and now they need to be the best they can be.
All right, we're going to cut to another commercial break. When we come back, we've got a couple of questions here. One has to do with co-signing a loan,
Okay.
very important, and also about this 8% in your fund. Okay. First of all, before we do, I want to also make a mention here. For sale in the San Francisco Bay aboard a luxury tall ship with a professional captain and crew. All sails depart from lovely downtown Sausalito. And check out San Francisco Bay, what it has to offer on the schooner Frida B. www.schoonerfridab.com or call 415-331-0444. All right, here is our next trivia question about numbers. How much is 4 score and 7? And it's not, the answer's not blackbirds, by the way, as in the Gettysburg Address. The first caller with the correct answer is going to win a free certificate at Tan Bella for 3 tanning certificates, which, by the way, you can use for anti-aging. You have to give them a call to find out what that's all about.
Better do it fast.
Yeah, that's right. Too much. Call 888-912-1190. Answer this question. How much is 4 score and 7 years? Don't touch that dial. The best of investing. We'll be right back. Hey.
Old school, 7 years ago. There's no recording of it, so you really can't know if he had an accent or if he just, or maybe he talked with a lisp.
You know, that's
Fuck,
true. We have pictures of him,
7
but
years
not.
Interesting. I think he had really, really light eyes. If you ever look at the photographs of him, it looks like he had just.
Well, I don't know how good the photography was.
Oh, that
back
could
then.
be. That could
But
be.
I would think he has probably a pretty deep voice.
He had a really tall hat on a lot.
That's right.
Yeah, tall and skinny guy.
Stovepipe hat,
6'4".
right? A guy like that, why would he have such a tall hat?
6'4", 120 pounds.
Yeah.
He was an interesting cat, though. And
Did
you
you
read
see
about
the
him.
movie with David
I
Davis?
did not
Oh,
see
yeah.
It
it.
actually
I heard it was
good.
good. Yeah,
Oh,
I
yeah.
heard it was good.
He did a
Really
good
worth
job.
watching.
Yeah.
Yeah. How many times did he fail before he?
Yeah.
Being a lawyer,
And
business.
and he lost his kids, right? His
Yeah.
wife.
Oh yeah.
So you want to do Rob first?
Sure. Some questions?
Yeah.
Okay.
Okay. Ready? Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hump and Rob Spinoza. Second trivia question about numbers. How much is 4·7?
87.
That's very good.
87.
1776 plus 87 is 1863, which is when he gave the Gettysburg Address.
Now, don't ask me how deep
You're
a
good at
fathom
math.
is, because I don't know that.
Don't
Don't ask me how deep a fathom is, because I don't know that.
Oh, it's some
Yes.
some non. Okay, so Rob, we have an email for you. It says here, I co-signed for my son's auto loan, but now I'm looking to refinance my own property. Will my mortgage lender count my son's loan against me?
Okay, so this is what we know in the industry as contingent liability. It means that there's a debt out there that you've co-signed on. You may not be making the payments. You might not even be the primary note holder, but it shows up on your credit report. So when you go to make a loan application, we see it there and we assume it's your debt, right? How do we know otherwise until you tell us? So the rule of thumb on this, and it is very nuanced, and it depends a lot on the type of loan you're trying to get, whether it's a jumbo loan or a conforming loan. But the rule of thumb is that if you're not the primary obligor, meaning that you are not you're not the primary note holder, you didn't make the loan, and the person who has been making 12 months of payments on that, and the payment history is good, we can generally take that out of your debt ratio. So you can get that basically out of the equation entirely if you have those things. It gets more complicated where you don't have a 12-month history. Let's say you just co-signed. Pretty much they're going to want to include the debt because we haven't proven that other person is making the payments on it. And if I could give any counsel to anybody who may be getting themselves into this situation, if you're going to co-sign on something, don't take the obligation on yourself for that person. Have that person go on it with you on the note, whatever it may be, real estate, auto, whatever it is, and it's just easier to document that way. Documentation is the key in our business because we have to prove everything.
You know, does the term cosign even really mean anything anymore? I mean, essentially,
It's a
what I've
general
been told that
Yeah.
it's you're on the loan with somebody else. I mean, it might as well be your loan.
For the most
For all
part,
intents and
that
purposes.
is the default position that we take. Is that because in the post downturn world, the Dodd-Frank world, we are working to prove ability to repay.
Yeah.
So every loan application that comes across our desk, if we don't demonstrate that the borrower had ability to repay, we could lose in any foreclosure defense. The consumer could level one against us, and we would say, well, we didn't accurately follow up on that debt.
Yeah, and I think decades ago, the whole idea of co-signing was that you were just kind of lending your name and credit.
Yeah,
But really, people didn't think it was going to actually impact them personally.
Right.
But now it
Everything's FICO driven now. Everything's credit
right.
score.
So for all intents and
credit
purposes, if you're co-signing, you're basically taking out the loan for that person.
Well, I remember some years back there was a guy who put up his house as collateral
Okay.
every time the guy for bail bonds,
Okay.
and it
Oh.
never came up. He kept making like $1,000 every time, and then one time a prisoner who was supposed to report jumped bail,
Yeah.
and he went to court and he goes, "Oh, well, I didn't really mean to put my house up," And
Yeah.
the judge says, "Well, but look how many thousands of dollars you made by doing it."
Yeah.
Yeah, you did.
Yeah, and there you go. That's exactly what we're looking at. If we say to an end investor, let's say that consumer comes back and says, well, I could never afford this loan because I have this car payment, even though it was my son's loan and he was making the payments on it, I was obligated on it, so I was actually making the payments behind the scene. We didn't document
That
that.
goes
Sorry,
for
we're in
personal
trouble.
guarantees and all kinds
Yeah,
of stuff.
yeah.
If they're public.
It's sort of like also like people who sign up for I'm not against the military at all, but it's just people who sign up for like National Guard and then suddenly
End up being deployed.
Yeah,
Yeah.
and it's like, well, wait, I didn't sign up for this.
Yeah.
Well, yeah, almost did.
No, you did.
I just wanted to work out on weekends.
Yeah.
Yeah,
I just
and
wanted
get
to
paid
go to
for
work.
it.
And Mark, you said, sign, you co-sign. It's still your signature.
There you go.
Still,
Ergo, the second
right,
part of that.
right.
Yeah.
Okay, so Mark, we have. Oh, by the way, how do people get?
How do people get on it? They can find me on the Best of Investing website. My profile is there. If you're ever, if you do a Google search, I'm on Yelp. Rob Spinoza in Mill Valley. I work for RPM Mortgage, 415-367-595.
And I bet you have a lot of stars on Yelp.
Got a lot of stars.
Bet you
but
do.
Hard earned. Yeah.
And no pictures in the post office. Okay, Mark, I received an email for you. It says, with interest rates still hovering in record lows, will you continue to pay around 8% in your fund?
Me personally, or the Pacific Private Money Fund, which is a mortgage pool fund that we formed at Pacific Private Money a number of years ago, due to the fact that we've been doing mortgage investing with individual notes and individual investors for many, many years, and we've done over 1,000 of those. And we got to a point where we had so many individual investors clamoring for the high yields that you can earn investing in mortgage secured notes. Anywhere between 8 and 10% on individual notes is fairly typical in the Bay Area. But we decided that since we had more and more people calling us and fewer of them were able to get in on notes since they're very competitive, we decided to create a mortgage pool fund, which is actually a pretty typical business model. As companies like ours grow, you get more and more investors, you reach critical mass. Now it's time to really take advantage of that popularity and start a mortgage pool fund. And if you're a reputable company with integrity and you get a good deal flow, meaning you get a lot of applications because you have to kind of weed through them. At Pacific Private Money, for example, we read through about 9 out of 10 applications. We usually say no to about 9 of them, and that one really fits kind of our niche that we're looking for. Short-term ability to repay, an exit strategy, meaning they're going to be able to pay us back shortly. We really exist in the real estate lending realm for fast, reliable financing when conventional or bank financing just can't come through for you. And thanks to Dodd-Frank and the fact that banks are a little bit, they're operating under much tighter restrictions now, thanks to Dodd-Frank.
Narrow box.
Our business at Pacific Private Money has been growing, and our investor base has been growing. So in 2013, we launched the Pacific Private Money Fund, which is a mortgage pool fund to allow more people to participate in the benefits of mortgage investing without having to compete with people who invest in notes full time. These people now can passively write a check to our fund, and those fund holders for the last 3.5 years have been earning 8% on their money. Now we have had a little bit of yield compression this year, and year to date we're about 7.8, between 7.8 and 7.9, still a really good yield. And as interest rates go up, that we expect that yield, we do expect that yield to go up again. But the question being, with interest rates at near zero, do we believe that we can continue to produce the rates at or near the 8%, which we've been doing historically? And of course, historical performance, past performance is not a promise of future results, but my prediction is that based on the demand level and what other companies are doing and our cost of funds and where we see the market heading, while private money rates have averaged downward towards 9 and even 8% in the Bay Area, I don't see a lot of continued downward pressure on that. I think we're going to maintain. We still do 10% loans, we do 9% loans, and between that blended range, we were able to produce in our mortgage pool fund approximately 8%. So for more information on that, go to our website, pacificprivatemoney.com, or give us a call and we'll reach out to you next week, 415-883-2150.
Very good. All right, we're going to cut to our last commercial break of numbers is the question. But before we do, also don't forget we still have paintball tickets that you can go on the Best of Investing website for I think it's 85% off. Or something ridiculous. They make great birthday gifts. So almost free. All right, here we go. How many face cards are there in a deck of cards? 888-912-1190. Don't touch that dial. The best of investing will be right back. Don't touch that dial. Just touch the dial on your phone. That's a good call.
Does anybody have a dial on their radio anymore? Don't touch that button.
Yeah. What do you want to?
So we've got a nice long segment.
You know, I was going to ask.
9-minute segment.
You want to go back around that again? I was going to ask you if you're seeing a younger demographic. Do you keep any track of that? Is that a good question to ask about that into the fund? A different.
Well, we did a presentation last night. Most of the people are
Older.
Yeah.
Ask me that. We'll do it, and then let's what
We
can
could do the
on yours.
the piggy bank one.
But I do have a deal of the week, that one that.
Oh, you want to right?
Yeah.
Exactly. No, that'd be great. And then
Okay.
then we can go into
Yeah.
Business Insider. See, TMZ of financial reporting. I just come across the most ridiculous articles on Business Insider. I'm always wondering. It's like,
I'll
who's
see what they have.
consolidating this?
Yeah.
Starting to use their homes as piggy banks. Oh, right. No, that's good. Yeah. I agree because there are.
We're seeing it for sure.
We're seeing it, yeah. Because it's not quite as bad as it was in
No, not even
in the
close.
early
Not
2000s, but
Back
those
in-
products are coming out again.
Yeah.
You know, home equity loans.
Back in the
HELOCs.
early 2000s, people were taking out cash out for vacations.
120% fake.
So Rob can ask me the question.
Yeah.
Okay.
We'll lead it that way.
All right, here we go. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Hunt and Rob Spinoza. Here was our last trivia question we asked was, how many face cards are there in a deck of cards?
That I don't know. I'm not a gambler.
14? 12.
Oh,
Jack,
yeah,
Queen, King.
Don't count the Joker? Two
No,
Jokers?
no,
What
face
do I
card.
know?
Yeah,
Face
that's
card.
that's
Oh,
the
okay.
face card. Jack, Queen,
Oh,
King,
you
and
were.
four.
That's a trick question.
Okay.
I thought it was a trick question. I thought 12 was too easy.
That's pretty easy. Okay, just a real quick thing. Tonight, actually, is the Weingarten Masquerade Party.
Ah.
And why would I be going to it tonight?
Got your
They're all
tux in
sold
it.
out, though.
Yeah.
They are all sold out. But
That's
anyway, check them
That'll
out
be
at
fun.
listenspeaklearn.org to see what they're doing for the community of children who are not prepared well with regard to hearing. Okay, so Rob, you want to ask Mark a question?
Yeah, Mark, we were talking earlier about the people investing in their 401ks. What I wanted to know is, are you seeing, as a result of the mortgage pool fund, are you seeing younger investors express interest in that kind of investing?
You know, I'd love to say yes. I actually do have several investors in their early 20s, but of the over 100 investors we now have in the Pacific Private Money Fund, the vast majority of them, I would say, they start in their 50s,
Okay.
in the 60s, 70s, and 80s.
That's what I would expect.
Yeah. You know, I just, I'm reading articles that support this, but it just seems that millennials aren't really all that interested in.
I just
Yeah.
think they don't. I just think
Well,
they
they're
don't know
interested in
about
money,
it.
but I don't know
you
that they're interested in looking out for their long-term.
Plus, you have to be an accredited
savings as a
investor
whole.
and stuff like that. So maybe
Well,
they
that
haven't,
too,
they haven't
that
taken
too.
steps. So
Right, if they're not accredited, so
Right.
that's why you do need to qualify with a certain minimum net worth value in order to invest in our fund. But again, for more information on our mortgage pool fund and how you can participate in mortgage investing for 8% or more
I think you're gonna see
historically on your yield,
Yeah.
on your savings, check us out at pacificprivatemoney.com.
Okay, so I usually ask you a deal of the week. Is the question that we haven't even talked about yet is, how can you pay those kind of rates?
Right, what kind of loans are
Borrow.
you making that would allow you to earn that kind of? They must be risky loans to people with bad credit who are in financial distress, right?
Not
No.
necessarily. Okay,
Not
so
necessarily. In fact, very rarely do I even make those loans.
I talked to a guy just a few days ago who owes the IRS $500,000 from past divorce and all this other kind of stuff. Business-wise, he broke up with his business partner, but now he
who's running for president?
Yeah. Anyway, then the guy does a very good job.
Okay.
In his job, he's making lots and lots of money,
right.
but he's got this IRS
He's got
lien
Albatross,
of $500,000,
yeah.
right? But he made this agreement with the IRS to pay them like little bits over like the next 500 years,
I've got a
right?
payment plan.
Exactly.
right.
So the IRS actually contacted him and said, "We want to get this monkey off both of our
Oh, right.
backs." Right?
Well, they
were
sometimes have
proactive.
programs where they'll say we'll offer you a
Settle.
discount.
Yeah,
There you
settlement.
go,
yeah,
exactly.
okay.
So it turns out that this guy can maybe get as low as a $150,000
Wow.
settlement and so that knocks $350,000 off of his lien. Thing is, it's on his house.
Yeah. Yep.
So the idea would be to get a loan that would pay off at least $150,000, and he has lots. Then he'll have lots and lots and lots of equity in the house.
Right.
And but the thing is, there's no bank that's going to lend him anything right now because he's got an IRS lien. So there's a good loan for you.
That's the catch-22. Absolutely. No, I love stories like that. There are, I mean, that's why we exist at Pacific Private Money, is to make real estate loans to people who are in catch-22s, and that's very typical. You got people who have equity in their homes, but they don't qualify for these new HELOC programs that we're going to talk about with Rob in a minute, and we serve those. And we also serve people who want to compete for a home in a marketplace that still is going oftentimes to cash buyers who can close quickly, and because it takes longer these days for many mortgage brokers to close a deal. Not Rob, but others.
No, we just brought the plane down on a couple of deals early. Really critical sort of contingent sort of stuff where the real estate agent was looking to close, another and needed one to close on time for that to happen. And we excel in situations like that because you really have to break down how is everything playing out, what are the priorities, what do you need to address first, and how do you get from point A to point B with all the variables. It's something we see a lot of, and I think private money does that exceptionally well because you don't have to jump through as many hoops. But we do see a bit of that too. What I was going to talk about, Edward alluded to it earlier, was Mark's favorite publication, Business Insider.
The TMZ of financial reporting.
The TMZ of financial reporting. I happen to bring in an article from Business Insider about people in California are starting to use their homes as piggy banks. Now,
wait a minute.
Yeah,
this is 2005.
Like ATMs.
This is a great headline because everybody wants to. They're all afraid of this, right? So. We are seeing more of this, but it is very different. What I'm seeing is very different than what we saw in the early 2000s. We're not seeing people do this carelessly or for very frivolous things. We are seeing it now. Where I like to see it most and best is when people do a debt consolidation of higher interest rates. Now, things that's really killing them, credit cards. And that's
as long as they don't go back into the credit cards.
Right. And you bring up a great point there. But responsible debt consolidation. We're seeing more of that because people have equity in their homes again, and there are a couple of different ways they can do it. They can reach it with a home equity line of credit, they can do a cash out refinance, they can do a fixed rate second mortgage. But we're seeing it across the board, and of course that raises some eyebrows. People are concerned we're headed back into a place where we have been before.
Dodd-Frank will allow that.
So yeah, I mean, I think that when you start looking at access of home equity, what we often see when it works best is people will consolidate higher interest rate debt. Maybe they'll do a little bit of home improvement. And at the end of the day, they'll end up with terms that are better than the terms that they're getting out of. So I think that there are opportunities out there if you find yourself in that situation. Those are always things worth looking into.
So how do the HELOC programs that, for example, that you offer at RPM Mortgage today, Rob, differ from the ones from, say, 2004 and 5 when they were giving them away like candy?
Well,
like Halloween candy.
Yeah, the main difference is you have to qualify for them now. In the vast majority of cases.
Darn.
Yeah, before.
So it's not just equity only. You can't just strip equity out of your property.
There were a lot of lenders, I'm not going to say who they were, back in the day that would do. They would look at the valuation of the house. They wouldn't actually do an appraisal, but they would do some sort of automated valuation, and they would look at your FICO. That was your application.
That was it.
Because if you had good credit and you had equity, that's all they needed to know. Now, more often than not, if you go back into the process to get a home equity line of credit or some other vehicle to access the equity in your home, your qualification is going to look eerily similar to getting just your regular first mortgage. I think that's the main difference. Again, HELOC lenders technically fall outside of Dodd-Frank, as you know.
Right.
So they don't have the ability to repay burden the same way a first mortgage lender does, but they do.
They still do it anyway.
They still do it anyway, and rightly so.
And it's good practice.
It's good practice, and the other thing is that your home equity vehicles, they're going to mostly follow prime rate, which is currently 3.5%, and you'll see a margin usually over prime rate. That's typical. But these are things. If you're in a situation where you've got other debts that are burdensome, mentioned the IRS stuff. Getting into things like that, you may be able to solve it with some sort of cash out vehicle.
What loan to value ratio are you guys going up to?
On a purchase, we'll go up to 90%. with a home equity line of credit. Okay.
Also, you do a first-second
First-second combination up to 90%. But when you're looking at some sort of cash-out refinance, if we do it simultaneously, we can still do 90. Most of your standalone home equity lines of credit are going to cap you at around 80, some 85. And then if it's anything weird, it's usually 70 to 75.
Those numbers just scare me because most people aren't familiar if you've never, contacted a private money or hard money lender like Pacific Private Money. But
Yeah, you guys are much lower.
we are actually more conservative in many ways than banks. Our shtick is our offer, our value is we're fast and
friendly.
Well, we're fast and reliable when you need fast money, but we're actually more conservative that we generally don't go over 70%. We'll do seconds, but we don't go over 70% generally on combined loan to value.
That's funny. So you're doing more conservative loans, but charging more.
Well, we often have people say to us if they somehow have missed whatever cutoff, they'll come back and well, can't I get a private money loan? And you're like, no. When it's a higher loan to value,
Yeah,
that
you
is
can't.
not private money space, and because that is their value. It's conservative loan to value.
All right, guys, we're going to cut to our last commercial break, and when we do, we're going to have some closing comments and some funny thoughts for the day. Stay with us. You're listening to The Best of Investing.
So Rob, tomorrow should be fun. So I got the impression that we're not live on his show. That he's going to record us for.
No.
later.
I think we are live.
Okay, we are
And
live.
then, but he'll have he'll have a recorded segment
Okay.
for.
I mean, I thought we were. I thought he was like
We are.
7 to 10.
Yeah, so we are going to be live.
Okay. All right. So when we do that, I just figured you would. You could take lead, and then I'm going to obviously chime in and continue and talk. It'll be a little bit harder because we're not going to be together. You're going to be on the phone. I'm going to be on the phone.
Yeah.
Unless you come up to my office at
Unless
9
you
o'clock.
come- yeah.
And even then, we don't want to do it through speakerphone because that kind of
No, well, we'd have to
isn't
be
good
on
radio.
Do you have two phones close to each other?
Oh, I do. Yeah. Well,
And hopefully that wouldn't create a.
How is the new space?
It's great.
awesome.
Yeah, it's a great looking space.
Thanks.
That was the old what? Redwood or what was
Yeah,
it?
Sonoma.
Sonoma.
Bank.
That's right. Yeah.
So, okay, let me think about that for a second. Yeah, we don't really have it's 9 o'clock and I don't want it to be outside where we're going to where people will walk by and make faces at us or do anything weird like that. You know what I'm saying?
Well, you
in
have
the
to
middle of
tell
the
them.
office, if it's in my office, I can close the door, but I only have the one phone.
What about the conference
In the
room?
conference room, we only have really one phone line.
Okay.
Yeah.
I mean, something serious like this, you could tell them not to screw around. They're not going to do that.
I just don't see us doing two phones.
That's okay.
that
I'll
close
just come
together.
here and I'll do it. And
Just
we'll
just do it together. Yeah, we'll just.
just if I hear you talk, I'll
Yeah.
not say anything.
But I'm getting. I don't know how he's going to open it up, but you could certainly start it by talking about our show, The Best of Investing. That we're new to KDOW, but we've been doing it for over 6 years now, and then I'll just chime in, and I'd like to talk about. Assuming that he may want to ask us questions, which is fine,
Yeah.
and we can react to it. But I'm hoping to steer the conversation towards mortgage investing.
Of course, and I think that's kind of what he's looking
Yeah.
for because again, there's no reason for him to talk about the show.
Right. And although he might want to go, he may want to ask about the types of loans that we make at Pacific Private Money if we get into the company.
Well, that's fine. But
Which
I'm
is
talking
fine.
I'm talking about the show. I mean,
Yeah.
there's no reason for him to talk about the best investing.
Right. Exactly.
But I'm kind of hoping that he, if it's live show, as commercials are going on,
Mhm.
and he's got like a couple of minutes,
Yeah.
he'll want to talk to us like this.
Yeah.
And then that way it'll be easy to lead.
Yeah.
I think that's probably what we'll do. We'll let him do his shit on that. Okay. This one's only a 5-minute segment, so
What do
I
we got?
only need like a minute.
Did you bring anything else that could
Oh,
be?
I thought we were actually done. I thought we were coming back.
No, it's 5
we have the
seconds.
wrap-up segment, the 5 minute and 10 seconds.
Let me think about this for a
Four
second.
Okay.
I don't know. I can't think of. Oh no! Got something like something really. I got some boring stuff. But
Boy,
Maybe-
yeah.
maybe-
Let's see. Let me tell the story on the.
you got a deal of the week.
I do. The
Oh.
biggest one. What I don't know is I don't know the details of why the bank couldn't close. There was something about his loan It's a $3 million loan on a $4.4 million purchase. He had $1.4 million down, 130 was non-refundable, and we got the call a week ago Monday from the realtor who said the bank isn't going to be able to close and the seller on time, and the seller will not give an extension beyond Friday, which he actually did because we funded Monday, closed Tuesday, but they were just like, they were done. It had gone on two extensions already, and the seller had a cash backup offer.
Well, it's probably one of those situations where the bank just couldn't get their ducks lined up.
Yeah.
You can tell
We'll
them.
talk about it. Okay. Good.
Well, welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hoff and Rob Spinoza. And Mark, you have an interesting story to tell us.
I've got a deal of the week, Edward, and the deal of the week it was noteworthy because it was actually the largest loan that we had originated with in-house investors. Now we've brokered large loans, $5 million, $6 million loans to larger private money firms that have larger mortgage pool funds or access to larger capital bases than we do. But our maximum loan amount's been creeping up. We regularly do loans between $1 and $2 million. This particular loan we closed was $3,080,000
It's a big loan.
on a $4.4 million purchase in Woodside of a beautiful home. In fact, so nice we're going to do a little email advertisement, kind of a just funded email blast to our mortgage brokers and realtor referral partners to let them know that, hey, we just closed this loan and very quickly. So I got a call a week ago Monday from a realtor who was desperate. The transaction that she was leading for her client, she was the buyer's agent, looked like it was going to fall through because the bank loan of $3 million had been, they'd already gone through 2 extensions on the contract. The seller was unwilling to give any additional time. They said, if you don't close this by Friday, remember she's calling on a Monday saying, if this doesn't close by Friday, the seller's going to keep the $130,000 non-refundable deposit and sell it to a cash buyer who was in backup position for a higher price. The seller was motivated. The seller was actually going to make, that was going to be like a real bonus for this guy. And so the buyer was, of course, justifiably upset. And we were able to do this loan. I wasn't sure at the time. It's like, okay, $3 million.
Yeah,
it was actually $3 million, but we baked in some extra monies for closing costs, which is why it was $3,080,000. But we actually did not close on Friday, but we were able to issue a letter of commitment to close that loan. And so this past week, we funded on our investor.
Wow.
In fact, funded on Monday, and we were on record on Tuesday. And so it was the largest loan that we had ever originated with private investors. We didn't put it in our fund because our fund didn't have $3 million. And in fact, I don't know that I would put a loan that large in our fund in its current size. Now, when our fund,
concentration.
When our fund gets $21 million fund, that's
And it was really, it just, as we kind of dug down as to, well, what happened with the bank? I mean, this guy he made great money, had over 800 FICO score. I mean, everything about him was golden. It's just that
those files are never simple.
Right. It's a $3 million loan is not a simple loan. There's not a lot of banks that will do that high of a residential financing, and they just couldn't wrap their arms around everything about this particular borrower who had, it wasn't a simple W-2.
No,
it was a little
that's the thing.
complicated.
There's not
People at that high net worth are never that simple.
And you were able to fund it in 4 days.
Right now, yes. Well, we were able to get a funding commitment in
because
literally a couple of days.
The residential mortgage lender is looking at all of the details and nuances of all of the things, but you guys are looking at it like this guy is gold.
Right.
This one's going to perform.
So we get the application on Monday. Monday afternoon, we start calling and smiling and dialing our investors. On Tuesday, we contacted a family, a high net worth family down in the peninsula who are actually licensed realtors among the family members. And so that Tuesday night, they went and toured the property.
I was going to say, they could go
called
see the
us,
property,
said,
right?
hey, this is great, we're in. And on Wednesday, we started the disclosure process. We're drawing loan docs on Thursday. They signed on Friday. We funded the following Monday and recorded Tuesday. I mean, it just all happened boom, 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 boom. And let me tell you, those type of transactions are never easy to do. I mean, we had to drop everything and get this file done. But the moral of the story is that that's why we exist. We exist to save transactions. And
that's a great story.
We're not a hard money lender out there making loans to borrowers in distress. We're out there saving deals for people, for families.
How do
So,
people get a hold of you again?
PacificPrivateMoney.com is the easiest way. PacificPrivateMoney.com.
All right, guys, here's our thoughts for the day. We're gonna cut out for the day. How's this? Why do we say something is out of whack? Well, what is a whack anyway?
But we're out of it.
Okay, we're out of it, yeah. And if love is blind, why is lingerie so popular? I thought that was cute. And then this actually comes from Jimmy Fallon. The NYPD is apparently teaching its officers how to be more polite, and it's true. Last time I got frisked, the cop was like, "Have you lost weight?" I thought that was pretty good. Thank you, Jimmy Fallon. That was funny.
That's a good joke.
All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. All the money. Excellent, guys. Excellent.